I made my first significant fortune at 42, but I didn't become truly wealthy until I was 77. You might wonder why it took so long. The answer is simple: I stopped doing what I shouldn't. Most people spend their lives chasing wealth like it's a magic ticket. The perfect stock. The next crypto. The insider tip. The miracle real estate deal. They're looking for shortcuts. And the truth? There are no shortcuts. The path to lasting wealth is built quietly, with patience, discipline, and, most importantly, avoiding mistakes that destroy fortunes. I've spent decades watching people, brilliant, ambitious, educated, ruin themselves over and over. And now I see it happening everywhere: people in their 50s, 60s, even 70s, realizing too late that the choices they thought were clever were actually lethal to their financial future. Here's the reality. There are 7 mistakes that, if you make them, will cost you not months, not years, but decades of potential wealth. You might already be making some of them. You might even think you're doing everything right. But let me tell you, ignoring these mistakes will leave you behind, quietly watching opportunities pass while others compound quietly and steadily. Mistake number 1: you learn only from your own failures. It sounds noble, right? Experience teaches wisdom. But here's the problem: time is limited. None of us can afford to live every possible mistake. So why not learn from the people who already did? For centuries, investors, entrepreneurs, and business leaders have documented their errors. And yet most of us ignore them, believing that this time will be different. It never is. Take history. The South Sea Bubble, Tulip Mania, the 1929 crash, the dot-com collapse, 2008 financial crisis, same patterns repeating. Greed, overconfidence, speculation. Every single time. People act shocked, as if they were the first to face these risks. But the stories exist. They are written, documented, analyzed. And yet, people rush in blind, expecting magic. Mistake number 2: you buy things you don't understand. I see it all the time. People spend hours researching a toaster on Amazon, comparing features, reading reviews, deciding which one has a bagel setting. Yet they throw thousands into complex financial products, cryptocurrencies, or startup hype without understanding a single fundamental principle. If you can't explain your investment in one sentence, if you can't answer how does it make money, clearly you are gambling, plain and simple. Smart investors don't need to chase every trend. They study, they understand, they wait. When they make a move, it's calculated. When they abstain, it's deliberate. They sleep at night while everyone else panics. And here's the kicker: by avoiding things they don't understand, they avoid the majority of catastrophic losses. They accept missing a few winners in exchange for never losing everything. Mistake number 3: impatience. Everyone wants to get rich fast. It's the world we live in. Fast internet, instant news, instant gratification. But wealth doesn't work like that. The big money isn't in timing the market or catching the next viral stock. It's in sitting, in waiting, in doing nothing while compound interest does its quiet, unstoppable work. I didn't become truly wealthy until decades of small, disciplined steps had accumulated. And it was boring. Painfully slow. For years, it felt like nothing was happening. But patience is the secret everyone underestimates. Fast moves might make headlines for a day, but slow, steady discipline wins over a lifetime. Mistake number 4, you think diversification equals safety. Wall Street tells you to spread your risk, own everything, from bonds to crypto to commodities. But diversification is protection against ignorance. True knowledge makes concentrated positions far more powerful. If you understand the business, the management, the industry, and the risks, focus. Focus is how fortunes are made. Spreading too thin often guarantees mediocrity. It's not about owning everything, it's about owning what you truly understand and letting it grow. Mistake number 5, hidden fees and taxes. This one is silent, creeping, and deadly. Every time you trade, pay a fund manager, or cash out, you lose. Most investors never calculate how much these costs are eroding their returns over decades. The difference between financial mediocrity and financial freedom often comes down to keeping what you earn, minimizing costs, taxes, and unnecessary trades. Simple math, ignored by almost everyone. Mistake number 6, emotions rule decisions. Fear. Greed. FOMO. Panic. These are human instincts, useful in a jungle, deadly in finance. When markets crash, people sell everything. When markets boom, they pile in. Smart investors recognize this pattern and do the opposite. When everyone panics, they buy. When everyone rushes, they wait. Emotional discipline separates wealth builders from wealth destroyers. Mistake number 7, quitting too early. Most people give up before the exponential magic of compounding begins. The early years are slow, frustrating, almost invisible. That's when patience is tested. And yet, sticking with the boring, proven strategy, reinvesting dividends, buying good businesses, ignoring hype, is what produces life-changing wealth decades later. Those who quit early, frustrated by slow growth, are left wondering where it all went wrong. The common thread in all of these mistakes is simple: patience, discipline, understanding, and avoidance of stupidity. That's the unglamorous secret. Not the hot stock. Not the latest trend. Not the viral investment. Just quiet, consistent wisdom applied over decades. And here's the brutal truth for you, watching this now. Most people will ignore these principles. They will chase hype, follow emotion, and quit too early. But if you don't, if you internalize these rules, if you avoid the obvious pitfalls, you will be among the few who quietly accumulate wealth over time. 77 years, I've learned this. And now, so can you. Rule number 1, learn from other people's mistakes. It sounds simple, but very few actually do it. Most people insist on living through every painful lesson themselves, convinced it will teach them more. And sure, experience teaches. But it also costs. It costs time, money, and sometimes your peace of mind. Why reinvent the wheel when history has already written the instruction manual? I spent decades reading about the disasters of others not because I enjoyed the misery, but because it was cheaper than creating my own. The South Sea Bubble of 1720, Tulip Mania in the Netherlands, the Great Depression, the dot-com bubble, the 2008 financial crisis patterns repeated, again and again. People chasing easy money. Everyone convinced this time is different. It never is. The same mistakes recur in different clothing. Leverage destroys wealth. FOMO leads to panic buys. Greed convinces people to bet everything on sure things. Every major collapse has the same anatomy, a few brilliant sounding ideas, mass delusion, and the exact same human weaknesses playing out across decades. And yet, most people ignore the lessons. They spend hours scrolling through financial headlines, watching TikTok investing gurus, or reading flashy newsletters that promise fast money. Meanwhile, they miss the lessons that could save them decades of regret. I read biographies of Andrew Carnegie, John D. Rockefeller, Benjamin Franklin not to idolize them, but to understand where they stumbled. Every failure they documented became a guidepost for me. I didn't have to fall into the same traps. I could simply pay attention, absorb, and avoid. Here's the practical advice: read one case study of financial disaster per month. One company, one crash, one bubble. Pets.com Webvan. Lehman Brothers. Bear Stearns. Enron. Long-term capital management. Each story is a lesson in greed, overconfidence, or human error. You don't have to live it, you just have to learn it. The beauty of this approach: it's faster, cheaper, and safer than trial and error. You compress hundreds of years of mistakes into a few months of reading. And then, when your own opportunity comes, you're prepared. You're not guessing. You're responding with knowledge, not panic. Rule number 2: don't buy what you don't understand. This is where so many investors go wrong. They see a trend, a buzz, a viral tip, and throw money at it. Crypto, NFTs, exotic derivatives, complex funds. They convince themselves they understand, but they don't. If you can't explain your investment in one sentence to a child, you don't understand it. You're gambling. Think of it this way: would you spend $50 on a kitchen appliance without comparing reviews? Of course not. You research, you analyze, you understand. Yet, the same people will throw $10,000, $50,000, even hundreds of thousands into investments they can't explain, because some stranger online said it was the next big thing. I learned early on that missing a winner is far better than losing everything. I passed on Amazon in the 1990s. Did it hurt? Maybe. Did it save me from disaster when the tech bubble burst? Absolutely. I didn't understand some companies. I didn't pretend I did. And that simple rule, if I don't understand it, I don't buy it, saved me from losses that would have taken decades to recover from. The key question you should ask yourself for every investment is simple: how does this make money? Not why it will go up tomorrow. Not why the chart looks bullish, but how does the business generate real cash? If you can't answer that, you're speculating, not investing. Let me give you a visual example. Imagine a simple business, a soda company. People buy soda. Company makes money. You own a piece. Easy. Clear. Understandable. Now, compare it to a synthetic financial product leveraging multiple layers of speculative mechanisms you can't even pronounce. If it takes a boardroom session to explain how it works, don't touch it. That's not investing, that's betting, and you're almost guaranteed to lose. Most people fail because they chase complexity. They want to seem smart. They buy products designed to confuse and impress, not to create sustainable returns. Avoid this trap. Focus on simplicity. Understand the business, the mechanics, the cash flow. If it's opaque, skip it. You don't need to hit home runs, you just need to avoid strikeouts. Over time, that's how fortunes are quietly built. And here's the emotional layer that most don't see: clarity reduces stress. Knowing your investments, understanding your risk, and avoiding speculation frees your mind. You sleep at night. You don't panic during crashes. You don't obsessively check prices or scroll through social media for the next tip. Peace of mind is priceless, and it's a hidden part of wealth that no flashy stock ticker can give you. These first two rules, learning from others' mistakes and only buying what you understand, are the foundation. Ignore them, and every other principle will crumble under your own mistakes and misjudgments. Follow them, and the rest of the journey becomes a matter of discipline, patience, and time. Rule number 3, you're in a hurry. Everyone wants wealth fast, as if money could grow overnight. But real wealth doesn't work that way. It's not in timing the market, buying the hot stock, or flipping investments for a quick gain. It's in patience, in compound growth over decades. I built my wealth over 60 years, not 6 months, not 6 years. The temptation to act quickly is constant. You see a meme stock triple in a month, crypto spike to the moon, everyone around you making money, and panic sets in. I'm missing out, you tell yourself. So you trade, day trade, options, leverage, chasing excitement instead of results. Meanwhile, the disciplined investor sits still. Buys an index fund. Holds. Reinvests. Over decades, 20% per year compounds $10,000 into $500 million. Not exciting. Not glamorous. But it works. The world rewards patience, not impulse. You don't need home runs, you need to avoid strikeouts. Small, consistent gains beat reckless bets every time. Rule number 4, diversification doesn't mean owning everything. Wall Street loves telling people to spread risk. Own 50 stocks, bonds, commodities, crypto, rights. Diversify, they say. But diversification is protection for the ignorant. If you actually understand your investments, you don't need 50 positions. You need a few businesses you know inside out. At one point, 90% of my net worth was in one company, Berkshire Hathaway. Was it reckless? No, I understood it. I knew the business, the management, the competitive advantage. The result? I died a billionaire. Concentrated, knowledgeable investing beats over diversification every time. If you own more than 20 stocks, ask yourself, do I really understand each one? Can I explain why I own it and how it makes money? If not, cut it down. Focus on quality, not quantity. True wealth comes from deep knowledge, not a cluttered portfolio. Rule number 5, stop bleeding money on fees and taxes. This one is boring but deadly. Fees and taxes silently erode wealth. A 1% annual fee might seem small until you realize over 30 years it could cost you hundreds of thousands. Active trading compounds the problem: commissions, bid-ask spreads, capital gains. Berkshire Hathaway doesn't pay dividends. Why? Because reinvesting profits inside the company compounds wealth tax-free. Every trade, every short-term sale, every unnecessary transaction is money lost. Minimize fees. Minimize taxes. Let your money compound quietly over time. It's the unglamorous side of wealth, but it's where the difference between millionaires and billionaires is made. Rule number 6, don't let emotions drive your decisions. Fear and greed are the silent killers of wealth. When the market crashes, panic sets in. People sell at the bottom. When the market booms, FOMO takes over. They buy at the top. This is the opposite of what you should do. In March 2020, the S&P dropped 34% in a month. Panic everywhere. Most sold everything. We at Berkshire? We bought more. Great businesses, huge discounts. By year end, the market fully recovered. Those who panicked locked in permanent losses. Emotions are short-term survival instincts, not tools for long-term wealth. Write down your investment rules now when calm and follow them during chaos. Rules protect you when your gut screams to do the wrong thing. Rule number 7, never quit too early. Wealth compounds slowly at first. For years, growth feels invisible. Most people quit, frustrated, thinking it's not working. But then, returns accelerate. The second, third, and fourth increments come faster and faster. This is the power of compound interest. I didn't become a billionaire until my 70s. That's decades of patience, discipline, and doing boring things repeatedly. The market returns about 10% per year long term. Stick with it. Don't chase trends. Don't switch strategies. Keep going, through crashes, booms, boredom, and fear. Patience and persistence are the true shortcuts to wealth. Avoid mistakes, stay disciplined, and time will do the rest. Most people quit too soon. They jump from strategy to strategy, chasing quick wins, losing sight of the long game. They see others making fast money and think they're missing out. The truth is, slow, steady, disciplined investing beats excitement every time. Wealth isn't about luck. It's not about timing the next hot trend. It's about avoiding stupidity, minimizing fees, focusing on what you understand, staying calm when markets panic, and giving time a chance to work its magic. The rules aren't flashy, but they work consistently, over decades. If you follow them, in 30 years, you'll be wealthier than 95% of people in this country. Not by luck. Not by chance. By patience, discipline, and doing the boring things right. That's the real secret. Most people already clicked away looking for the next 10x stock or crypto moonshot. That's fine. Less competition for you. More opportunity for the patient, the disciplined, the long-term thinkers. Remember, avoid mistakes, stay consistent, never quit, and let time compound your efforts. Do that, and the results will speak for themselves.